Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow.
All right, welcome to Market Call. I am Dan Nathan. I'm joined in studio by Danny Moses. You know him as Demo. He is Guy and my on the tape partner. Demo, welcome.
Thanks, man. I'm wearing the uniform here.
I know we're just all
gray.
It's a gray day.
Gray
here. Every day's been a great day for us, especially if you're a little bearish, which we have been. I don't know. I keep getting more bearish, Danny, on the major indices. I don't get less as the market goes higher. We also have Carter Braxton Worth of Worth Charting with, there he is. You didn't get the memo, Carter. You get the memo.
God, he looks good, though.
He does look good.
I got the gray memo. I was like, I don't know, probably needs a little color in there,
For some of our regular listeners / viewers, you may know that Danny and my main man Carter, they go way back. When Danny was at Front Point with
Oppenheimer.
Oppenheimer.
Yeah.
Oh, you guys worked together, correct?
Yes, we did.
Well, Carter, we're hoping to get a few war stories today with Danny in the seat here. Maybe there's some good stuff.
Well,
there.
Maybe one of the charts will come up and
All
it'll create a situation.
Yeah.
Remember,
No doubt about it.
dreamy time or a nightmare. We'll remember something.
Well, listen, lot going on. Holiday shortened week, as we know. Fed Chair Powell spoke this morning. We have non-farm payrolls on Friday. Which day is tomorrow? A half day, or is Friday?
Tomorrow's a half day.
Tomorrow's a half day. So Friday's a full day. But you got to listen. Everybody and their mother, they're gone, right? Like, so Friday is going to be dead as a doornail. So we'll see what happens here. Quickly, let's just look at the rundown here. We're talking about bad breath. Our main man Doug Cass sent a bunch of really interesting charts. We talked about poor breath yesterday, narrowing of the market. So we have some stuff that kind of helps tell that story today. Fab 5 back to Mag 7. Remember they called it Mag 7. They were like, you know what? You lost Apple, you lost Tesla. It's the Fab 5. Well, they've kind of gotten on their horses. So Mag 7, despite Tesla still being down on the year. And Carter went out with a note on Worth Charting about housing stocks. We've all been bearish about them, especially as rates have moved up from 4.2% in the 10-year up to where they are currently right now, close to 4.45 or something like that. We're going to take some questions. So please put them in here. Guys, let's just hit a couple of these, narrowing breath sort of thing. This is from Mike Zaccardi. This is him summarizing in a tweet. BofA's data, only 24% of stocks in the S&P 500 outperform the index year to date, marking the third narrowest 6-month period in the history since 1986. Was narrow in July of 2023 at 23% and in Feb 2020 at 21%. Carter, really quickly, on Worth Charting, you do this Factor Friday, and it's a really interesting bit. You take different metrics that you are looking at, and you kind of expand them a little bit. How much time do you spend on breadth and the narrowing or the concentration of the indexes and the performance of the indexes and the EPS growth of the a handful of names in the indexes?
Yeah, no time with the latter, right? And the Factor Friday sort of product is basically not from our point of view. We simply take the 100 stocks or 50 stocks that have the highest or lowest rating or reading per a dozen or so factors, whether it's volatility or dividend yield, high or low, or earnings growth rate or earnings revision. We don't spend any time on it ourselves, right? And don't track it and don't follow it, and don't care about it. But it then allows for people who might be interested in that particular factor, a value investor who wants a low PE parameter, and then singling out charts that are good by our work in that category. Now, it's also a sort of a surreptitious way, maybe wrong word, to poke fun at the fundamentals in the sense that if you think about it, if you had a screen that says the 100 best EPS earnings revisions, wouldn't the charts all look the same? If you had the 100 best sprinters in the Olympic trials, pretty fast versus the guys who trip over their shoes. Point is, if you had a bunch of stocks that all have the same characteristic in terms of ROE, you would think the charts, but the charts are always different. And so it's a way of saying the charts are what matter most. Factor Friday.
All right, Danny, let's talk a little bit about this sort of data. We talked with Mike Wilson on the tape last Friday. If you haven't listened to that, check it out. It's in the On the Tape feed. It was a great conversation. Again, Mike got a bit more constructive on the markets, maybe about 1.5 months ago, 2 months ago. But he's also like thinks the risk reward is very poor here. That's something we spent some time in. When you see data like this, and we actually have a couple more charts that we'll get into a little bit, what does that make you feel? You could have said this at any point, you know what I mean, in this rally. And we just talked about how Apple and Tesla just joined the pack. That only makes it a bit more severe. It's broadening out among the mega caps, the trillionaires, but it only makes that concentration more severe, I guess.
Yeah, listen, Mike made a point to say that you're getting a select group of stocks that do have earnings growth, right? That are certainly immune to the rate cycle, so to speak. So you're getting those. But I also asked Michael that day if how much passive investing has had an impact on all the stuff that we're seeing, and it becomes self-fulfilling as you create all these ETFs around all the Mag 7 and Fab 5, whatever they are. It becomes self-fulfilling as money finds its way into them. So you get this breath by nature. The problem is if it ever unwinds itself and comes out, that's what you need to be ready for. And I think Mike's point is there are many stocks below the surface, and Carter points out, that are not participating in any of this rally, that are underperforming the S&P, that are probably ripe to be looking at if there was a sell-off in the broad. So I just think it's going to become at some point more of a stock picker's universe. This has been kind of close your eyes and just, point, you're okay. So that's how I kind of look at it.
Yeah, but we've talked about this, within tech, there's been some discrimination. Enterprise software has been really weak. Consumer internet, many names that are not exposed to cloud and AI, have been kind of weak. There's areas in retail that act very poorly. There's some transports don't act particularly well. So there's a lot of stuff. I mean, Carter, we've talked a lot about rotations and sectors and the like. When you see this sort of concentration, a lot of folks will tell you, okay, well, the rotations have kept the indices afloat here a little bit, but at some point correlations, go to 1. And maybe that's with rates going back above 4.5% on their way to the prior highs from 2 months ago at 4.75 or something like that. How do you see, like, when it's like Nvidia went down 15-16% from its recent highs, but the S&P and the Nasdaq just stuck around? And I just want to get one more chart that Doug forwarded us from Charlie Bolello. He's looking at the weighting of the top 3 holdings. This is from 1980 to this year. And you just look at that: Microsoft, Apple, and Nvidia, and it's just blowing it out over a 44-year period. So talk to me a little bit about this and the potential for correlations to go up greater, because there's definitely been a bit of dispersion, but it's these mega caps who've kept the thing afloat.
Right. If you look at the relative strength or ratio chart of the equal weight to the actual, it doesn't always correspond when you get an extreme reading like this to a market top. For instance, the very chart that's on the screen, what is that peak when it was IBM, T, and Exxon? It looks to be 1982. What did the market do from 1982 to 1987? It ripped. Meaning, just because there's concentration doesn't mean it's a market top or bottom. But it both is a positive, negative thing, because if a champion, why do you think they pay the star athletes 10 times the other people? Because if the champion keeps performing, LeBron, Michael Jordan, or who's the captain of the Yankees, I mean, they win, they fill up the seats, it works. That's the point. You pay more for good stuff. You pay more for expensive handbags and shoes and good hotel rooms than bad ones. But at some point, if that sort of magic trick falters, your champion falters, then you have a problem, because presumptively what's been carrying the team, what's been winning the game, what's been making the market go up is the champion. If the others can't also lift weight, then you do. So as long as it's working, it's a virtuous thing, but it can turn ugly quickly if it doesn't.
I know we're going to talk about an economically sensitive group here in a minute, but when you look at this, not at this necessarily, but when you take a step back, you realize companies are getting punished right now for missing earnings. And I think the backdrop of that is everyone knows that the economy is slowing. How fast it's slowing? Not a lot, but it is slowing, right? So it's definitely peaked. And so companies that are exposed to the economy that are now missing numbers are getting duly punished, not unduly. But the money, to your point, Dan, is finding its way in the market in certain areas, and people want to stay involved, want to stay invested in the U.S. markets, and they're picking safety in numbers, so to speak, that aren't going to be influenced by that. So I think that's kind of what we're seeing, to Carter's point. And you can have a market sustain rally and spread out, but I think right now the headwinds are going to be in the economy. So
it's interesting. So the whole shooting first and asking questions later, in the beginning of last quarter's Q1 earnings cycle, we saw you know, a JP Morgan go from 196 down to 180. It had 6.5% 1-day gap, okay, which was massive right after their earnings, right? And then we saw Netflix and Meta, and there was a handful of other, you know, big cap names that they all filled in their downward gaps in the not so distant future. And some of them made new highs, as in the case of JP Morgan. Meta's kind of flirting with them. Netflix is too. And I just think that behavior is very interesting. I want to pull up the S&P 500 futures chart here because, you know, when we talk about, you know, how we get some sort of intermediate sort of top, I want to go to the left-hand side of this chart, okay? 4,600 in the S&P futures, that was the July highs, okay? And look at that. It sold off about 10, 11% or so to the October lows. We're up probably 35% from there. And when you think about this Mag 7 and they make up over 30-some% of the S&P 500, I just want to make the point. The reason for the sell-off was for, as Carter calls them, fundamentals, right? So a lot of these AI related companies, the same sort of concentration that we had into the spring, into the summer, right? Well, once Q1 earnings came out and Q2 guidance was very clear, there was no real reason to buy them at that point. And so off of the October lows, some of these products and some of these companies began to kind of get more clarity around their strategies. And then it was just multiple expansion, right? And it was basically paying forward the excitement about the future. So Carter, when I look at this chart, you can draw a pretty simple uptrend, right? And maybe you're just attaching 3 points. So you're going to probably say not so much authority. Look at that 150-day moving average that's rising here. Thoughts on here that as we get into Q2 earnings, okay, let's just say with yields where they are, look at that. Amanda's just killing it. With yields where they are, maybe we see some more concern about net interest margins as it relates to the banks. I think next Friday, we're going to have JP Morgan, Citi, and Wells Fargo. And then we kind of get Netflix and into the big tech earnings towards the end of the month. Thoughts on the S&P 500 setup, because we had that move to new highs and we're just consolidating here.
Right. So whereas the cash index has made a new high, of course, the futures have not, and have been very range bound post gap. And that gap was the day that Apple and other things really came to life in a big way. Look, I'm in the reduce exposure. It always is who you are, right? A lot of people literally are day traders. They're just trying to scalp and make a buck. I mean, they're not. They have money with advisors, or they leave their Apple alone, haven't touched it since 1981, whatever. But for this kind of thing, they're quite short-term traders, and so. To that extent, I would be, if you have to do one of two things, buy or sell, I would be reducing and selling.
Yeah, Danny, do you look at some of this stuff? Like, for instance, that is the 150-day moving average. The S&P, at least the futures, are about 8.5% above that. That's a pretty for an index. That's pretty aggressive. And as we quoted to Mike Wilson on Friday's pod, and Doug Cass brought this up to me too, is that NVIDIA is 100% above its 200-day moving average, and that's the third largest stock, you know, in the S&P 500. Are these things that concern you a little bit, like as far as technical inputs?
Sure, but I've never looked at the spread between futures and cash. I haven't spent a lot of time on that, so I won't comment on that. But if you go back to your chart, the one thing that happened in the fall of last year was the Janet Yellen, you know, language change, whatever, that took the pressure, at least temporarily, off of yields and put confidence in the market. Because the one thing that was hindering the markets, obviously, were the higher yields. So it gave people an excuse to buy. Ever since then, though, it's been Fed's got our back. They're going to cut rates at some point. We can stay in. We can stay invested here. But Dan, at some point, the law of large numbers that you're referring to will catch up, and you better know what you own. And I've said this many times before. Just because NVIDIA has gone from, you know, where are we? Did this today live, right?
It's down a little bit today, but it's so 121. It was down from 140.
Right. So 140 to 120. I've said all along. Why is 120 the buy point? Why is 125? Why is 115? Why is 110? Why is 105 the buy point? You go to, 50 times projected earnings down to 35. What does that mean if you don't keep lapping that type of growth? And you can't keep lapping that growth. So, between the insider sales at a company like NVIDIA, pay attention to what people are doing, not what they're saying out there. And I do think that it would pay here to take some money off the table. And I agree with Carter. that, lighten up here at these levels.
Well, you know
certainly.
what's interesting? I was talking to a friend of mine who's a trader at a big bank, and deals with a lot of major hedge funds. And he just said to me, like, I just said, "What's the mood out there?" And he's just like, "There's just really no fear right now." You know what I mean? Among clients, they're not hedging really anything. They might be hedging single stock positions or the like. And again, that puts maybe a little bit of a floor on some of these names. But when you think about NVIDIA, by probably 2-3 weeks from now, 40% of their revenue comes from, the names, Microsoft, Amazon, Google, and Meta. And we're going to get a read on their CapEx. You know what I mean? And so to me, I think that's really important. And I think it has the risk of setting up not too dissimilar from what we had in late July last year. But Carter, I know you look at the options market a little bit, and I wanted to look at the SPX, which is trading, let's call it 54.90 or so. So the 54.90 puts on September 30th. So the end of this quarter, okay? So the end of Q3 are trading at about $98. And you can do that math, okay? So that's a little below 2%. $98, 54.90. That's cheap as chips if you think about it, right? And so I guess if I had a portfolio that mapped Q2 earnings, Q3 guidance, Jackson Hole, this is the Fed symposium at the end of August, where we know that we've often got some shifts or at least some kind of telegraphing of what might come next. And then we have the Fed meeting, I think it's or September 19 or so. What do you think about?
And you've got seasonality. It's one of the worst periods. Yeah. And you've got, at that point, an election right around the corner. Yeah. I mean, 2%, and after that, you're in the money. I'd make that bet big.
Yeah. All right. Well, Danny just mentioned some groups that are very economically sensitive to rates. You had a note out on Worth Charting on the Homebuilders. Let's walk through this a little bit, Carter, because this is one where in the XHB, I've been, looking at it from a put position, targeting that kind of support that the XHB has had. But you want to look at the ITB. So run us through a little bit what you're seeing. And by the way, there was a downgrade this morning, Citibank, Lennar, and DR Horton from neutral to neutral from buy.
Yeah. So obviously the ITB is the one that's pure. It's dedicated. They both, ITB and XHB, have things like Home Depot and Lowe's in them. But in ITB, the home builders are most heavily weighted, with Horton being some 14%. But what this was really was a follow-up from a sell home builders note recommendation to clients on March 18th. And so the question was, despite this, let's say, good outcome, home builders are down, and they're on a relative basis, they're really down. I think there's more. And so it was trying to make the point that, yes, as a trade, this has been happy, but stick with it. Or if you haven't done it, start it again, start it new. And so big, obviously, spread. That's a lot of basis points. And so far, so good, but I think there's more. Let's look at the absolute charts. And there's the annotation, March 18th. At the point, the thought was, hey, we're up against the upper band of the channel. Sell home builders. We did go a bit higher, as you'll see. They went through the top of the channel, but with a little luck and a little good timing, things start to come our way, so to speak, and we've come down considerably, obviously. But where might we be headed? The formation is clear. Next chart, if you want. I think just getting down to the lower band, which would be a sort of very similar move to the preceding sell-off of 20-21%, is what's likely. Home builders are down today, happily, and so just sticking with the Q1 March 18th call and reiterating it.
The key to that note was they actually cut numbers in 2024, right? That hasn't happened in a while on the builders. So that actually kills the momentum in the names. And what is more economically sensitive? If people are praying for a rate cut, two things have to happen. Unemployment needs to go up, right? And inflation needs to come down. Housing gets hit, obviously, on unemployment going up. And a quarter point, obviously, here or there, doesn't mean anything. So it's a long tail. This has had quite a run. And we've had Ivy Zellman on, and we should get her on again soon. I think these things are at an inflection point where builders tend to trade at worst from, to 0.5 times book value, and at best kind of to 2. Many of these names were approaching 2 times book or at 2 times book. And so to Carter's point, I don't know where that line is, but I'm guessing it's still north of 1 times book, even where that support is down 20%. It's probably 1.2. And Dan, just to round out on this XHB, just looking at, you're right, it's not a great metric because Williams and Sonoma is the top holding.
Yeah,
You don't get to a builder until like number 8.
Yeah, except
Total.
that I like that exposure to some of the retail names too, because we've seen some of those, act particularly poor
Sure.
too. And there's some names that have acted particularly well. You know what I mean? Like the RH versus the Williams Sonoma is kind of an
I just go
interesting
back
trade.
to stock picking. That's all
Yeah,
I'm saying is
yeah.
like, you could take out 5 of those. Some of these are infrastructure plays that
Yeah.
are sitting in there. But anyway.
Yeah, well, I mean, listen, Whirlpool is in the
Yeah.
XHB that acts like
Right.
unholy death. I want to go back to one thing before we get to some single names here. And you brought this up a second ago there, Carter, is like the equal weight S&P. We talked about it yesterday. It broke that uptrend that had been in place from the October lows. It's kind of consolidating here a little bit right above that 150-day moving average. Doesn't act particularly well, which brings me to something we kind of led with is like we started out with the Mag 7. We went down to the Fab 5. Now we're back to the Mag 7. And that's why, to me, I think after the performance of Tesla up 65%, we're going to look at Tesla in a second, and Apple has had this huge rally off the April lows, and then obviously the breakout recently is pretty epic. And that's why, to me, I just think the spread between the equal weight and the market cap weight is pretty interesting, especially if there's a fundamental reason for them to kind of turn a little bit. So like just mentioned Tesla, it's having a day today. It's up 9%. I think all of us, I said it on Fast Money. I was talking to some folks, the other day who cover the stock. Like, listen, this was a bad press into this delivery number. I think a lot of folks remember that Q1 delivery number, and the stock made a new 52-week low on it. It was much worse than expected. Expectations had come down pretty dramatically over the course of this quarter. While they're still down year over year, what they reported, it was much better than consensus. So it's interesting that this stock has gone straight up in the last, week or so. Maybe it's close to 20%, but you're seeing what I'm seeing in this Tesla chart. And so I'd love for you to run through it from those 2021 highs when the stock briefly touched above $400, Carter.
Sure. So what's fun about this is that before we sort of change any charts, it always is, it's forever when one got involved, right? Where did you start the story? You ever showed up late to a game or late to a movie? It's like, oh, wait a minute, I'm a little bit. So while we're looking at this chart, and before we annotate it and to draw any lines, one could say, was it a winner? Remember, from this starting period on a 5-year chart, the S&P is up 83. This is up 1,350%. Tesla's still one of the great winners of all time. But just as Bitcoin came apart and then recovered, you have to get your timing right. That's the whole point of my existence and many people's and both of you as well. But let's also draw some lines. And so, this kind of thing is annoying. Again, I like to say it because it gives me pleasure. This is annoying to the Federal Reserve Bank. This is annoying to HBS. That'd be Harvard Business School. For those of you who didn't attend, I didn't either. It's annoying to the CFA Society. It's annoying to the CPAs in the world. They're like, what? How can this be? Well, it is. Let's put some arrows in. This stock has traded like a pinball machine within these converging trend lines. And so the note that was sent out to clients is just play the cards as they're dealt. Make the bet that it goes down. Does it have to? Of course not. If it's wrong, use stop loss. 2, 4, some people like 20% stops. But do you buy or sell Tesla here? I think you fade it. It's a big move to a difficult level.
At the end of May, the estimates for deliveries, I'm talking about 448,000.
Yeah. What'd they come in at, Danny?
444.
Yeah.
Okay. It got lowered to 436. So they quote, beat it. Production was 410.
I saw that.
Okay. So maybe the people in the quarter could be okay because they're not manufacturing and
but they brought down inventory.
Right. So we don't exactly. So we don't know what they sold that stuff for. It is what it is. But here's what I love. The bulls on it will say it's not an auto company. On days like today, it's an auto company. It's going to be re-accelerating again in next gen. So it is what it is. The beauty is in the eye of the beholder, or the ugly is in the eye of the beholder, to Carter's point. So to me, if you're chasing it here on the long side, why are you doing that? You got Autonomous Day on August 8th, right? The unveiling, all this. I still don't buy into that.
I still think this is a short squeeze. Wouldn't you think so? I mean, a lot of folks.
I can verify that.
Yeah, it's a short squeeze.
It's a short squeeze.
Let me ask you this. So, one of the things that was pretty evident in the quarter, I think they were buying down rates down to like 1% or something like that. So that's got to be a hit on margins. I know they were talking about, storage. That's such a small percentage of their revenue. So when you think about, the focus is going to be on this robo-taxi event, and, maybe it rallies into that. But to Carter's point about these charts, I mean, you use the term all the time, to the penny. 6 times it's been rejected at this downtrend, and I think that's what you're saying. And you want to make that bet that it maybe goes back to that uptrend that it's bounced off of 3 times or so.
I would say one other thing to this that gives this gain maybe a little bit more validation.
Yeah.
Is that we've seen the SEC and rulings from the courts in the last couple weeks become more powerless and more powerless. One of the bearish themes, obviously, on Tesla is that Musk commits, crimes, financial crimes, so to speak, and he's not going to be basically held to that standard any longer. So I think part of this also is that if you're short this because you believe that Musk will get taken down at some point, I think that's been wavering. So I think that's the other non-fundamental element.
But that's never been a particularly good bet.
No, it's not a good bet. But in the last few weeks, it's become evident that if that's your team,
it's just, what's interesting. You know why he never gets taken down is that SpaceX is too important. You know what I mean? Like think about Boeing just sent up this Starliner to the ISS and it was meant to come back, after 6 or 7 days, and these guys have been up there, these astronauts, for almost a month. You know what I mean? So they're desperate, NASA, to get a second source or a second supplier. But SpaceX seems to be the only game in town, and now the value is just skipping up. It seems like there's just insatiable demand in the private markets for it. So again, interesting story. I'm sure we'll be tracking it definitely into August 8th. All right, Carter, let's look at Apple. This is interesting because this stock was kind of stuck in the mud, if you think about it, meant to just be a real laggard in the AI trade. It's had, a very big rally off of those April lows here. That blowout move just kind of, surprised me in a way, because after WWDC, that was, I think, June 10th, the company laid out their vision for Apple Intelligence, which is something that they were going to do basically on device. And a lot of investors that first day were pretty unimpressed because they thought, again, these services are going to be rolled out over a period of time. And so the next day, though, the stock just took off in 2 consecutive days. It's consolidated, in and around this level for the last couple of weeks. It looks like a little flag above, a very long consolidation. Thoughts here? We see your green arrow. I think I know where you're going on this one.
Yeah, I mean, so remember, of course, it's on a relative basis. Its relative performance peaked 20 months ago. It was in September of 2022, Apple versus its sector, information technology. So it's been a really unhappy instance of committing capital in terms of not being up or down, but opportunity cost, right? It's one of the worst single stocks in the sector when so many have done well. That being said, the absolute chart is the absolute chart, and it has recently broken out, as we know, and it's not extended in any way. That's such a well-defined level from which it did finally break out. The breakout is nascent, new to my eye. I put the green arrow there, and if you look at a longer-term chart, the same setup, and we have it here. That's not a kind of thing where you say, "Oh, it's overdone." I would be inclined. There is also this, and it has to be considered too, that if one is thinking on the cautious side, one is thinking that perhaps equities as an asset class are full, and that there is the risk of some sort of give back. Apple's relative performance is likely to be very good, right? By virtue of its cash, by virtue of its sort of low beta, which it is. And so it's maybe a chance or a case of have your cake and eat it too, being long outright. But in the event of a general market swoon, I would think Apple exhibits impressive relative strength.
I think that, and the fact that the money that's come out of NVIDIA, that's where it's gone.
Yeah, no doubt. Hey, Guy Adami's not here, but he's just always working here. We appreciate that. He just put in this tweet from in our group chat from Charlie Bolello. And so again, Apple's price to sales ratio just moved above 9, the highest valuation level in the company history. And we just bring this up. This is a $400 billion revenue company, right? So when you see 9 times sales, pretty astounding. We have high teens for NVIDIA, and that company's doing maybe $150 billion in sales, up from about 25 a year and a half ago, which is pretty amazing too. And so again, I think a lot of what's happening here is multiple expansion. In June 10th, after WWDC, the stock closed down 2%. The next day, whether it was the machines or the powers that be, they're like, we're taking this thing up. And then a price to earnings multiple, it's not particularly cheap either. So this company better deliver that upgrade cycle that a lot of people are playing for, because, if not, we could be in room, for, at least a retest, Carter, of that breakout level. Would that be something where you'd be like with both hands, like reloading on that one?
Yeah, I mean, obviously, that to some extent you've already had a bit of flagging, which you saw there, from which it's then gone again. But a sell-off to the level from which it initially broke out, about 8.5% lower from here. I'd put new money to work there for sure.
All right. I just want to hit these names really quickly. These are some of the quick serve, fast serve, whatever you want to call them names. We've been talking about McDonald's for a while. It's down 15% of the year. There seems to be like a value menu war that's going on. Look at that thing. It's approaching, 52-week lows, and it's back to below levels that it's kind of bounced off. Maybe they can pull that out to a 5-year chart a little bit and see what lies beneath, if you will. And, to me, I just think this is really interesting because to Danny's point about, we've been talking about the trade down that's been going on in retail for some time. You've been very bullish of the Walmart that's trading at, all-time highs, it seems like every day, Danny, because of that trade down. When you see McDonald's acting this way, this far off of its all-time highs just made a few months ago, and then really underperforming the S&P 500, what does that make you think about McDonald's?
It makes me think that price increases at some point have their limit to what the consumer can afford. And the consumer that goes there, for the most part, is being hit the hardest right now with what's going on in the economy. And so I think people are just, it's not an expensive name here by nature, but there used to be a Big Mac correlation to the price of oil. And the whole concept was you fill up your car and whatever's remaining, you go buy a Big Mac or,
so there's nothing remaining after you fill up your
exactly. Car. So I just think that all these other consumer items are hitting, right? And that's what it's just absorbing what people can afford. So
Carter, quick take on the chart.
I mean, what's so incredible, of course, is that it said that it's October low, right? I mean, from which all equities bounce. Were the market to be at the October low, we'd be 10% lower in the S&P than where we are now. That being said, it's a very bifurcated group. We know Starbucks is under the same kind of pressure, and yet Chipotle up and to the right, steep and uncorrected. Wingstop, steep and uncorrected. Loved, very expensive, even Domino's. So it's these two big heavy weights in the S&P 500 restaurant sub-industry group, McDonald's and Starbucks, that are under particular pressure.
Yeah, and I just wanted to bring up one of the names that you just highlighted, Domino's. Again, that was lower left, upper right, until it just broke that uptrend, that's been in place from the October lows or so. When you see this sort of price action, though, what does that make you think that possibly some of those outperformers, Shake Shack has come in pretty hard? I mean, there's a whole host. For as many that you just mentioned that trade really well, there's a bunch of really important ones that trade very poorly, Carter.
Oh, for sure. The key with Domino's, of course, Domino's never got back to an all-time high, right? Never could exceed its 2022 highs, whereas the ones that are truly through the roof, that would be Wingstop and Chipotle. So Domino's, right, never could get back above, and now a bit of a rollover here. The ones that are truly parabolic are these Chipotle and Wingstop. At a minimum, I'd sell calls. So Chipotle, look at that compared to its prior high, or WANG, even more parabolic. And these are maybe new concepts. Like I say, they're new concepts, and so that's why they're good. McDonald's is boring, or what have you, or Starbucks is, it's just coffee. You can get that anywhere, and you can only get a Wingstop at Wingstop. Leave that to someone else. But the point is, there's two ways to interpret: is this idiosyncratic strength and they have room to run, or are these ultimately vulnerable as well? Because not only are they so stretched, but that the cost pressures or whatever is ailing Starbucks and McDonald's will come around and get these as well. That's my inclination to the latter, but we shall see.
Yeah, you can't say valuation because some of these other names that are working, they're kind of fully valued above like any historical norms. All right, let's take some questions here. We have a few already, and if you have one, like throw it in there. Amanda will kick it over to us. This is a good one for you, Danny. This is from Max P, and it kind of expands on that conversation that we had, XHB versus ITB. Do we buy Home Depot in Lowe's for the coming hurricane season? And again, that used to be a trade that used to happen in August, in September. And it's interesting. What do they call this, barrel or something like that? It just ripped through, a lot of Caribbean islands, and it's going to make landfall in the not so distant future. It's not, I don't know, Danny. What do you think?
There always, I think there is a seasonal play to that normally, but God forbid you get that. Yeah. Well, if you're going to go long those for hurricane season, go short the insurance companies. Yeah. At the same time, I look at PGTI, which is the window replacement company, which has had a huge run since all the hurricanes hit in the last few years, and states are mandating hurricane windows and doors, things like that too. But yeah, I think that's a short-lived phenomenon. I think Home Depot and Lowe's are facing other issues right now, obviously, that are going to face the builders, but certainly for a pop, you can get that. But if that's your theme, then go short the insurance companies
Yeah.
as well.
All right.
So.
Here's one from JS, who's here every day. Thanks, Jay. Please ask the guys what sign tells might be the end of a great run for DXJ. Why don't, Danny, you give us a little fundamental take? I know you've been focused very much on the yen. Dollar
Peter
yen
Bookvar has
pair.
done a great job on.
So talk to us a little bit about that. So this is the DXJ hedged. Okay, so that's good for currency moves here. Thoughts on Japan equities, because again, they were kind of stuck in the mud for an awful long time, and now they've been performing very well at the top of the tables as it relates to global equity markets.
Yeah, and I think topics within that, I think the bank index within Japan has done well as well. So I think you need to believe that the Bank of Japan are going to start to be much more accommodative, because if they let this thing run its course, obviously, right, and the yen keeps weakening like this, which I think is the attraction. Now, you said this is hedged out in the currency, so I have to go through that. But that's been the attraction, I think, is money has flowed back into Japan on that belief that things are firming. But when you take a step back from Japan, the debt to GDP and all those things, it's really got to be a stock-by-stock basis, in my opinion. The dollar, yen hurts certain importers. Obviously, oil becomes more expensive to the nation and so forth. So I haven't done a ton of work on this, but it certainly has been. It looks a great looking chart, and Peter Bookvar is your source on this.
Yeah, Carter, do you agree that it's a great looking chart?
I mean, this is what's up and to the right is without getting too steep. Notice how it pauses, it pulls in, it consolidates, and then reasserts itself. The one thing about the Topex, of course, is the biggest single sub-industry group in the Topex is electric appliances. Of all darn things, of course, Sony and Hitachi are being the big weights.
That's some like 80s stuff, right?
Right,
there.
that's right. And so it was always and banks are the second biggest weight, and then transportation and so forth. It's a value kind of thing. Tech being a small part of it, but to think that Sony, Hitachi, and I think in the Nikkei itself, fast retailing is some 18-20%. Toyota Motor. So it's particularly, as is the case in our index, U.S. index, it's dependent on just a handful of names. But the Topex as an aggregate is much cheaper if you just look at a trailing P. It's probably 17, 18 versus the Nikkei at 25 or 26. I'd have to check those, but I'm pretty sure they're somewhere in that zone.
Okay. And just to add to Carter's point on that, obviously things that export cars, Toyota will totally benefit from a weak currency over there in terms of strength. So
no doubt. I mean, that strong dollar here too is one of the things that might start to hurt multinationals from the U.S. One last single stock name, and then we're going to finish it off with one macro sort of situation. ANF. This is an interesting one. This is from Aaron Richards. How about ANF with weakness in retail seeming probable? So again, I think this is like the crux of this question is, okay, if the consumer is going to start to moderate, listen, some of the confidence data has been okay. You know what I mean? Especially as we've gotten, unemployment back to 4%. Let's see how much it goes above that when we get some of the June numbers or so. But Carter, this breakout was on massive authority, massive volume. It was on earnings. It's been consolidating a little bit. That 150-day moving average is getting up there right near that kind of breakout level. Thoughts on ANF?
Yeah, it's a business that is boom bust. It's a fad kind of thing. If you go to a website like this, you'll see they have jeans. It's incredible. And they have sweaters. They've got shirts and blouses, handbags. I mean, it's amazing. No one's got this kind of thing. Point is, this has been boom and bust its whole career. It was $7 in the COVID low. $7. It's $185 right now. Which price is right? Probably 7 was maybe overdone on the pessimistic side. I would suppose that 185 here is a little overdone because they don't have weight loss and they don't have new artificial intelligence. They have handbags and jeans and sweaters and t-shirts.
Yeah. So Danny, and again, you don't have to know a lot about ANF. I think Carter was being sarcastic there, people, when he's saying it's amazing that they have sweaters and jeans and the like here. So one of the, kind of parts of this has been an earnings story this year. It's expected, and we're just one quarter into it on the year, but to have like 50% earnings growth, but that's set to decelerate to low single digits next year, and then about 10-11% revenue growth this year, and then mid-single digits next. Is trading at 19.5 times this year, about 19 times next. So again, it's not particularly cheap, only a couple turns below the S&P, but it is up 650% in about a year and a half or so. And to Carter's point, it was $7 at the COVID lows. So thoughts when you see that sort of multiple expansion for some company that is not part of these mega trends. And that's what Carter's keying on.
Again, I think within the sectors themselves, I think passive flows have a massive impact. And stocks that do well and get bigger over time will only get bigger. So if you want to hide in something that looks okay, it is expensive, but still has growth. But at some point, you lap it. At some point, those same store sales, you're gonna hit those things again. And there is a lot to be said, though, for merchandising, having the right product in the right place, in the right markets. And there are companies that are better at it than others, and the bad ones go out of business. I will tell you this: the cycle that we're going to probably end up going through. I think if you're missing numbers now already, you're not involved in any of those retailers. You are involved in Abercrombie right now because, again, you want to feel safe that you can own something and it's very liquid. So I think it's getting a premium for those reasons.
All right, here's one I want to pull up, though. This is not a question. Pull up Lululemon. This stock's down 40% on the year. It's down more from its all-time highs. Here's a company that, again, I think it was trading $500. Now it's $300. You know, pull up a 5-year chart here. You know, we also saw that gap in Nike down 20% last Friday after their earnings. And so here's one where, again, maybe they kitchen sinked, you know what I mean, on that guidance when the stop gap lower, and it kept on going here. But I look at this, and consensus is calling for fiscal 2025, which is the current year that we're in, about 12% or so earnings growth this year, 11 or so percent. That's revenue growth. So 12% this year, 11% next. And then earnings are about the same, 12% this year and 11 times next. Good balance sheet, trades at a market multiple of 21 times, 19 times next year, you know, flat-ish margins or so. But to Danny's point, what he just said is that if you were to see a meaningful slowdown, you know, in the consumer and unemployment start to tick up, this is the sort of, you know, discretionary name that probably has more downside. But again, it kind of looks interesting to me if you just think of it as if they're able to kind of hit these double-digit earnings and revenue growth numbers and margins don't get hit hard from discounting and the like. Carter, what do you see in the charts really quickly?
Yeah, I mean, down a lot, right? You're down some 40, 50%. Doesn't act well day to day. We know price volume correlation is bearish. Drops and gaps on heavy volume repeatedly. We know that the relative strength is poor, and we know that it's acting not only poor to the market, but to other consumer names. But poor to Nike? No, there are other stocks in this category that are really struggling. There is an analyst out, of course, we've talked about this, who said it's going to be like Under Armour. It's just going to all go away because they're in the bell bottoms. I can't speak to that. It seems knowing too much too far out in the future. If you can know where something's going to be in 4 or 5 years from now, you might want to keep that to yourself. That's pretty valuable. That being said, I wouldn't want to be long. I would be concerned, worried.
Okay. And then, Danny, any thoughts on that move in Nike on Friday? Because again, when you see, you know, a down 20% move in a name that a lot of people love to own, and you were talking, Carter, a little bit ago, like, you know, some people never sell, you know, Nike, they never sell Apple, they never sell GE, they never sell Microsoft. So I'm going to put Nike in that category. But again, if they just pull up that chart, looking at that gap, you know, from Friday, you know, I thought this is one that maybe you can buy with like an 80 low in the aftermarket when it's trading there. But to see this thing get that schmeistered, you got to think maybe there's weakness abound in some of the other high valuation consumer discretionary names.
I think there's a shareholder boycott until they change upper management. Is what it feels like to me.
I actually think, do you think though this could be activist bait a little bit, especially if you have the CEO, you know what I mean, kind of on the road?
Well, he didn't say that they're using AI to build running shoes.
No,
that was a big mistake on his part to not mention. No, but in all seriousness, it obviously was very, very disappointing. It had come a long way at some point. I think if you go back in that chart even farther, China concerns have been an issue, obviously, for the company, international, right? Labor issues for the company. And listen, there's other brands that are taking market share from them for a period of time.
You wear those on clouds.
Yeah, well, on clouds and things like
Adidas,
that. So,
you ever see every other woman you see in New York are wearing Adidas Sambas right now.
Exactly.
That's a fact.
What is the ratio? I'd have to go back and look. I think over a period of 100 years, 95% of companies go out of business. I'm not saying Nike's going out of business, but you bring up a point.
It is that high. Or 98% of all stocks underperform 90-day T-bills.
Right, or something like that. But my point is that the haves and the have-nots. And so Nike is an elephant that you got to kind of turn around, right? It's not a quick fix. Lululemon had done it years ago, but now they face so much competition in knockoffs, yoga pants. So again, I just think there's a lot to choose from when it comes to Nike and in terms of other companies and brands that people buy.
Yeah.
So
by the way, I just kind of left my office, walked home like 6 blocks and came back, and every other woman was wearing Lulus. I'm just purely anecdotal, and I don't mind them. I think that's a much better look than the baggy sweatpants. Maybe we all agree on that. I'm just saying. All right, one last question here before I get myself in some real trouble. This is from JS, and maybe we can all quickly well, no, it's not from JS. Which one is this? This was the macro question. I just kind of wanted to hit this. This is from Wavy McFly. Wavy, you're here all the time. We appreciate this question. What is the single biggest threat to this rally? All right, so I'm just going to take this really quickly. I mean, to me, it's not geopolitical. People want to bring that stuff up. Mike Wilson said this the other day, and I thought it was a really good point. I think all of us would agree. You know, trying to trade the stock market off of what might happen from a geopolitical standpoint, there's about 10 hotspots around the world, and you could have identified the same 10 a year ago, 2 years ago, that sort of thing. And generally in my, lifetime, I've not seen the stock market get hit too hard from too many things. And, 9/11 was probably one of them. Right. But again, we saw, a quick, over the year, we saw, a little, getting it back and then new lows and the like. And so again, who knows? To me, it's pushing out these rate cuts. And I think that would be this thing. And then, careful what you wish for. We've talked a lot about it on the tape, Danny. If you do see rate cuts because the economy is slowing down too much, that's probably not going to be a great thing for valuations in the stock market.
You just nailed it. The biggest threat is you don't get the downturn in inflation, and keep in mind that we're starting to lap easier numbers in inflation, and Powell knows that.
Yeah.
But then what if you get a downturn in the economy? To your point, the Fed chooses just to cut rates to save the economy versus worrying about inflation. The market will see through that. That is the biggest risk that inflation stops going.
Carter, thoughts? Because
maybe productivity. I mean, I think the narrative for so much of the euphoria and the up move and the belief is related to productivity, artificial intelligence, semiconductors. So were there to be some whispers, hey, we're not quite seeing that, we're not getting the intended outcome from, of course, because AI is spending, right? We're not getting what we wanted from the spending. It's not, you would have a turn or two of re-rating in the market's margins, and then that would represent a sell-off.
Yeah, I think your point about productivity, it also means somewhat monetization of some of these AI investments, right? So if companies, when they report, are not able to kind of point to how they're going to monetize these investments, and then you have a slowdown in the economy, well, that means that you're also going to have CapEx cuts by many of these companies, right? So we heard a lot in 2022 into 2023 about the year or so of rationalization. We heard that from Meta. We heard that from some other big companies. Now, some of them had already beefed up on the metaverse stuff, and Meta was one of them, right, in 21 and 22, and then they were able to kind of reposition some of those investments for AI, so it worked out for them. But I agree with all of that. All right, guys, we did a lot of heavy lifting from Carter and Danny. I really appreciate it. Guys getting some well-needed time off. He's going to be back with us on Monday. We kind of have an abbreviated schedule this week as a half day. Tomorrow, we're going to be dropping an on-the-tape podcast. Danny and I are sitting down with Halima Croft. She is a brilliant commodity strategist over at RBC Capital. So that's going to drop tomorrow morning. And on Friday, we have a really cool OK Computer that's going to drop. I sat down with Paul Rabel. He is a lacrosse legend. Some might say the GOAT. He was one of the founders with his brother Mike of the Premier Lacrosse League. And it's just not about lacrosse, the conversation that we had. It really is about him founding this league, some of the challenges that he had in doing that. And it really is, he's a tech entrepreneur, a media entrepreneur. And so it's a great conversation. So check that out on Friday. And then the last thing, Carter, I don't know if you know this, but about 6.5 weeks ago, we launched a new podcast here at Risk Reversal Media. It's called The Market Matrix, MRKT Matrix. Every day it comes out really shortly after the close. Our whole team, Guy, Danny, Amanda, Jacob, we all kind of curate what we think are probably 10 of the most important stories of the day. We have them summarized in one of these AI bots. So it's not AI generated, it's generated through some AI, kind of bots. We put it into a voice bot, and you get your podcast in under 10 minutes or so to some of the stories that we think are most important. So go to your podcast stores, follow it, rate it, review it, share it with a friend. Okay. So you can all do that in the podcast stores. All right, Carter, we really appreciate your time. Danny, we appreciate you sitting in on the desk. It was a lot of fun. We'll see you all next week on Market Call.